Okay, good evening. Thought I would do something a little bit different. I've got your Coney and Misty updates coming, but before I launch into those, let me talk about what I wanted to share here. And that is an article I had read the other day that I think says a lot. I've been worried about a potential bear market. So there are two definitions that I see. A lot of people say a bear market is when the averages, be it the Nasdaq, be it the Dow, recede 15%. Other people say it's 20. So I'm kind of going with the 20%. And I've been unsure when we're going to see that. I was thinking maybe as late as September, we could start seeing some signs in May or June. But kind of with the war climate that's going on right now, that's what I'm attributing to some of the downturn, is just the war climate or potential war climate. But I wanted to share this because I think it's important. And then what kind of strategies can you have in place if you're worried there could be a bear coming, right? Because everybody looks in the rearview mirror and they say, oh my God, the Nasdaq's run up, the AI stocks, everybody wants to chase all the high flying stocks. Well, guys, I learned when I was 23 and I had to pick for my retirement account a stock, and I went out and searched the stocks for the last 2 years, and I got a big winner, and I picked it and put all my 401k money in that stock. Yeah, it had done 171% the year before and 40% before that. Well, the next year it was down 35%. But I was looking in the rearview mirror projecting, right? So anyway, let's see what this has to say. I think it's important to hear it. Okay, it says, and this is common sense. When examined over long stretches, the stock market can't be beat. And I would agree, but what's your stretch? Sometimes it has a fantastic 10-year market. Other times it's good for 20 years, sometimes 30 years. Personally, I went through the 1990 to 2000. I was working in high tech. I was working for one of the biggest tech companies, what they call the four horsemen of the internet era. I was making tons of money, and my stock that I was given by the company was going up. We were all, quote, millionaires. But reality hit, right? The 2000 bubble burst. The Nasdaq went from 5,000 to 1,500. All of a sudden, by 2001, 2002, we were all scratching our heads, are we ever going to make our money back, right? We lost a lot of capital wealth on paper from stock values and other things. So I took a hard look, internal look. When did I want to retire? How was I going to retire? What sectors? And at that time, in late 2001, I discovered that gold and gold equities and commodities were going to be the ticket, what I call more real things, right? Lumber, coffee, sugar, foods, all those kinds of things tremendously. And then I specialized in gold. I didn't know energy as well. Now I do, but I didn't then. And so I just started picking gold stocks and commodity stocks and derivatives of gold and made 8 times my money on the next 8 to 9 years, just by focusing on a sector and learning how to trade it, how to manage it. And so just understand that money is always flowing. Even in a bear market, money is going somewhere. But you have to be very careful if you're using the rear view mirror look, because the rug will get pulled out from under you. All those people that said, oh, it doesn't matter if my favorite .com stock, they got a lot of eyeballs, right? That's every valuation's on eyeballs. Well, pretty soon it came down to, did they make any money? And that's why 90% of them went out of business, right? So anyway, without going there, I do just want to alert you to what all this is saying. It's basically saying the stock market's a great way to return wealth over time. But you really need to take a look at what is happening. What are some of the factors in there? Okay. it says, you know, picking the right stocks, picking the right sectors. That alone is difficult, right? So let's talk about what this money supply is. So there's two things that the economists look at, M1 and M2. So if we dive in here, it says among the 5 measures of money supply, M1 and M2 tend to garner most of the focus from economists in the investing community. M1 is pretty simple to explain. It's all the available cash and coins in circulation as well as demand deposits in a checking account. It's basically money that everyone would have easy access to that can be spent immediately. On the other hand, M2 money supply accounts for everything in M1 and also adds in savings accounts, money market accounts, CDs below 100,000. Still money you can access, but you got to work a little bit harder to get to it. Oh, I don't want to pull that out because I'm going to lose my higher interest. I got to wait 30 days, yada, 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 right? So that's the money supply right now that's raising eyebrows for all the wrong reasons, okay? Economists, investors tend to pay very little attention to M2 money supply because it's grown with such consistency over time. Okay, but look at what's happened to it. So they have ways of measuring all this. 2 years ago in March 2022, M2 money supply reached at approximately 21.8 trillion. Based on the latest monthly data released from the Board of Governors of the Federal Reserve System, M2 clocked in at 20.78. Okay, so that's down about a trillion in February of 2024. As you can see in the chart alone, this represents a relatively minor 0.5% year-over-year decline, but a more pronounced 4.29% drop off since March of 2022. It's also the first meaningful move lower anyone has witnessed in M2 since the Great Depression. So this negative 4.29% retracement in the U.S. money supply may be a reversion to the mean after M2 expanded by a historic 20% on a year-over-year basis during the height of COVID-19, as multiple rounds of fiscal stimulus flooded the U.S. economy with cash and consumers who were more than willing to spend it. All right, but let's take a look at the chart. So I've got a separate picture. I'm going to overlay this and we can drag it around. So this is M2 money supply year over year, right? Percentage growth. So we see we took off here, right? During the COVID times in 2020. And since then we've been pulling back. So here we are at a minus 2%. We have not seen an M2 at minus 2%. I'd call this a false breakout, right? Came down to the zero line, looked like it might go down, but look, there's been a lot of times where it went down to 1%, 2%, 2%, no problem, right? But when's the last time it went down here? Let's see, we had a 2% in 1920. But this we all know about. This was the Great Depression with 25% unemployment, right? So from 29 to 32 is when all of that was taking place. But look at these other times. We'd have to go back in the Spanish-American War period, 1890s, 1870s. You know, I didn't really look those up, but they call it 1870s Depression, Panic of 1893. 1921 depression. I guess there was a depression prior to the Great Depression. Well, even we didn't have this in the 2008 economic malaise, right? Which is one of the greatest economic declines we've had. So that would have set right over here. So we weren't even, 2% on the M2. To the negative, we were 2%. At the 2009 period, because that '08 decline carried into 2009. Some of you, I'm sure, remember that. Okay, so moving along on this, Not to say we're going to have a depression, not even going to say we're going to have a bad recession. I think the financial tools that are available to the people in power can almost eliminate a depression on the 29 scale. But it doesn't mean we don't go into a bad recession and the markets move down. So how do we prepare for that? What do we do? Let's go back to the article and let's finish seeing. So Gurley noted that there are 5 instances. So they introduced Gurley, who's someone who's been tracking this, right? And he posted Nick Gurley, Reventure Consulting CEO, posted out on X, Twitter, for those of you that know it by that name, on data gleaned from the U.S. Census Bureau and Federal Reserve to track M2 movements since 1870. So he's behind bringing this to people's attention. So I just bring it to your attention just as a reminder, right? Do you have a plan B? Have you thought about what you might do if you're in investments and you see them pulling down? You know, you can direct cost average. Certainly that's one method, right? But is it better to maybe go to the sidelines with some of your investment? I would think so. Write it out. Nobody says this is the Great Depression. And how long do these last, right? So when we look at things, the S&P 500, it's official. A new bull market has been confirmed. So Bespoke, and I have this chart so we can blow it up, looks at bull markets, right? And remember how I said I labeled it as 20%? So the S&P 500 is now up 20% from its 10, 12, 22 closing low. The prior bear market saw the index fall 25.4% over 282 days. So make a note of that, right? 30 days in a month is 270, so a little over 9 months. And that's pretty typical of bear markets, right? So we'll have a bull market that's 2.5 years, and we'll have a bear market of 9 months. For those of you that haven't experienced, go out and look at one of your favorite companies, or go out and look at a chart and look at the last bear market, right? Go back in that 22 time frame. And when these stocks turn down and the market really turns down, it can take 5 trading days. And you can have 19% of the 22% or of the 25.54% decline happen. You talk about volatility. When it moves down aggressively. So it's different than the upcycle. We tend to layer, right? 3 steps up, 1 step back, 3 steps up, 1 step back. You know, we're climbing the stairs, right? Well, when it decides to plummet, it's more like the elevator just went down 5 floors. It's nothing like 3 stairs, right? So be aware of the things. So I can pull that chart up if you care to look at it. So all this one says it tracks every single bear market. And the purpose of this was we only wanted to look at bear markets that came after bull markets, right? Sometimes you have a bull market and then many years of trading sideways, but we're just finishing up a bull market that came after a bear market, right? So we want to see what's the probability we could extend this time. And going back, it basically says, where does it? Okay, these are both 20%ers. This is just the chart. So anyway, with this video, if you want to stop this and you want to explore these, I don't want to take your time going through every single statistic on there. I just want to point out what could be happening, you know, what we do about it, okay? And one of the things is maybe we make an assumption here for a minute. Let's say, okay, maybe Bruce is right. Maybe we do. Oh, there's one other picture I wanted to share. This is somebody that I pay to follow some of their work. And he posts on X and follows commodities. He follows, you know, energy. He tends to follow commodities more, but he also tracks the Dow Jones and the Nasdaq and things of interest. And he says here, look, this is a recent top back in early March, right? We're short from near the top, and eventually we are moving, meaning we're starting to pick up momentum, right? How far? I don't know, but this is a rough guess for now. So again, when people who look at these things, and I look at a lot of charts and I read a lot of analysis, so let's assume here for a minute all this is a little blip, and we've got another, 3 or 4 days of down, right? But if you go back and track the Nasdaq, it looked like this was starting around 18,400 if I had to guess on the chart level. It looks like we're at 17,720. I mean, maybe we only go to 1690 or 16,900 and bounce, right? Nothing, by the way, you never have an 80% crash where something goes all down continuously. There's always moves down and moves up, right? Counter trends. So I had been thinking that we were prone to a 20% decline, and I'd been trying to estimate when it might start. So this could be a scenario where we go down here, go up, go back down one, go up, and you really just have to measure about a 20%. But I was kind of thinking that September is when we finish the bottom of the 20 to 25%. So I wasn't sure what the setup going into that. But it could be something like this. This has got us going up, back up, and a lot of times what will happen is you'll retest the breakdown, right? You see, you kind of have this head and shoulders. You got a high point here, and you could build out a shoulder here a little bit more before we decline. And then you could bounce right back up to test the bottom, and then turn around in September and decline to whatever level. I'd really need to put some Fibonacci's in here and put it on a chart where I can measure maybe 25% from this top. And understand that not everything goes down to that level. You want to move into some entities or stocks, or to the sidelines, or to money markets or something. And even dividend stocks aren't bad, right? I happen to cover two very volatile in Coney and Misty. So I'm more concerned with what's Bitcoin going to kind of do if we have this bear pullback, because sometimes it has its own bull cycle. And so far, it seems to be shook up and going down, right? But we haven't reached the halving impact. So I'm going to talk a little more in my Misty and Coney updates later tonight about what I see in the Bitcoin influence and how I think it trades, right? So anyway, let me give you what I was going to tell you on, this is the final piece. So let me just talk about 9 bear market investing strategies for a market downturn. Didn't say we're completely in one, but we could be getting pretty close. Okay, wait it out, right? When stocks begin to plummet during a bear market, you may be tempted to try and cut losses by selling, but for long-term investors, it's usually best to buy and hold stocks as usual, even during economic downturns. What I think the wisdom one should try to see is my analysis going into the last year when I saw this final part of what I call the euphoria in Dow and in Nasdaq and in tech stocks, to me implies somewhat of a high and a bull run. So if we go in a bear market, the bear market might be 6 to 9 months, and we might get a 20% retracement in most everything. Not everything, but most everything. And then when we enter the next period of time, it could be 8 years. It could be like back in 2002 when I discovered what was going to do well between 2002 and 2010, really. It turned out it ran into early 11, was a change in where people put their money. They still put it in the stock market, but they went into a commodity-oriented investing cycle, right? So I'm already sensing that's the investment place to be. Well, there's a lot of sectors within the commodity cycle. Do you want to go foods? Do you want to go energy? Do you want to go metals? Right? There's all kinds of things to play that. Do you want an alternative currency to, or a risk environment that's now been regulated and approved like Bitcoin, right? I happen to think Bitcoin and gold will do very well, both, in this next series of years. Okay, so I mean, you can wait it out, you can stay in, but sometimes when you wait it out in the wrong sector, it goes down 20% and it recovers, but maybe over the next 8 years you get maybe a 30% gain. When you look at 30% over 8 years, it's minuscule. It's 3% a year. Most people are expecting 15, 20%, right? So you don't necessarily want to be in a high yield dividend stock on tech if you don't think tech is going to do well. So again, these are some of the things I try and keep up to date on. Hedge your bets with dollar cost averaging. Always good. If you pick a sector, if you pick something you like and you want to stay in it and you see it moving down, by all means, dollar cost average. No one could ever argue that. Diversify, right? Is it stocks? Is it bonds? Is it cash? What do you want to have it in? Invest in defensive industries, right? Are the ones that people tend to use even in hard times. We all know in a recession that people tighten up, they hoard, they don't want to spend their money. But when it comes down to it, there's certain things you have to spend your money on, right? So maybe initially Netflix, and I think it did, it sold off hard yesterday, but Netflix goes down because, less subscriptions. But the reality is, I'm staying home now. I'm not going to the cinema. I'm not going out to eat as much. I'm cooking at home. So therefore, of course, I'm watching more Netflix, right? So there's just things that you do. Warren Buffett says here, has said that he buys during bear markets for this very reason, right? Blue chip stocks to take a dip. He once called the 2007 an ideal period for investors. So again, the old saying is, you buy when there's fear in the markets and everybody else is selling. You sell when there's greed in the market and everyone else is buying at a top. Buy dividend stocks. Well, that appeals so far to a lot of the people that I'm talking to, because I'm covering 2 high yield stocks and plan to cover some more. I'm also waiting for some bear market high yield funds to be approved from the SEC for YieldMax. And then, like I said, in some cases I'm doing my own. I'm already picking the stock and I'm putting a different kind of synthetic, right? I'm just creating my own, what I call long stock bearish synthetic. But I can talk about that more in another video for you guys. Just hit me up in the comments if that's of interest. Use short strategies. Well, these are easier said than done, right? You got to be careful shorting some stocks, because if they pay a dividend, they have a yield, you get responsible for that. Also, a lot of the exchanges and trading companies charge you interest on a shorted stock. So put options certainly are a way, and I've got 2 different videos already out on how to sell puts to make money. So take a look at those, right? Go for the goal. Gold can be a strong long-term investing strategy. I just closed one of my short-term Newmont synthetics out, but I plan to get back in that probably July. I see the next big run in gold stocks in July. I don't like the way they're performing right now. Gold started recovering with a war fear, but the miners sold off for no real reason, I think, and they haven't started back up. So I'll get back and I'll put a new position on in that. So that's all I had for tonight. I hope you find this informational. Again, it's not. I'm not a financial advisor. This is not financial advice. Give me comments, like, subscribe. Have a good one, and look for my Coney and Misty later tonight.